Hi, Professor Rex here. In this week's video, I'm going to focus on the two dividend stock portfolios in yellow, in which we invest additional money on the first trading day of every week. They are the Dividend-Growth portfolio, which was started in 2022 and now has an annual return of 22.24%, and our high yield stock portfolio, which has an annual return of 24.83% per year. The high yield portfolio was started in 2023. On the chart, I've also included their benchmarks for comparison. I recently started putting the list of dividend growth stocks that we buy each Monday on a Substack newsletter. You can sign up for the newsletter for free. You can find the link to the Substack newsletter in the video description. Again, it's totally free to sign up for. I'm trying out Substack to see what it's like as a platform. And since I'm new to Substack, the newsletter is nothing fancy right now, but it should get better over time as I learn the platform. In next week's video, we'll talk in depth about our newest portfolio, the tech stock portfolio that was started last year by my accounting students and I, as outlined in red, and now has an annualized return of 25.76%. It's one of our newest portfolios, and because it's 100% invested in tech stocks, it's our most volatile portfolio. Like our dividend stock portfolios, the tech stock portfolio is a real-world investment portfolio where I make additional investments on the first trading day of each week. So in effect, all three portfolios are accumulation portfolios, mimicking someone in their working years who is consistently adding to their investment portfolios. Next week, we'll also talk about our wide moat and capital light portfolios, which are also beating the S&P 500, as well as our new sector rotation strategy. As a reminder, the portfolios on the right in the light blue outline are portfolios I started in 2003 when I was in college. These portfolios are more buy and hold portfolios with infrequent trading, so their lack of action might make for boring videos. So you can go online to beatthestockmarket.com to read more about them if you're interested in less frequent trading. Now, in the past, in my videos, I've discussed ways to potentially boost the return of our dividend stock portfolios, but that usually requires giving up some portfolio diversification. But depending on how much diversification you require, that might be relatively easy to do, as our dividend growth stock portfolio currently has 102 holdings. Our high yield stock portfolio has 36 holdings, and our tech stock portfolio has 25 holdings. Here is a summary of our investment strategies, their annual returns, when they were started, and where you can find them. The dividend strategies are my personal favorite, since my goal is to generate passive income that is twice my annual expenses. The dividend growth stock portfolio seems to be the most popular, so I put it on Substack for free, as I mentioned before, as an experiment to see if I like the Substack platform. I may eventually completely switch to Substack. We'll see. Meanwhile, you can find most of the strategies on my website, beatthestockmarket.com, but if you can't afford a subscription, I alternate my weekly YouTube videos showing you the dividend stocks we've been buying one week, and then in the next week's video I show the tech stocks, wide moat stocks, and capital light stocks we've been buying, as well as information on our sector rotation strategy. In this green box up here, note that I've added a note that the tech stock portfolio and capital light strategies are both newer, and therefore the average investment has been held for less than a year. This means their annualized returns can fluctuate a lot until the holding period eventually grows. For example, the capital light strategy is by far the newest, as it was started in February of this year. The average investment in the capital light strategy has only been held for 78.4 days, as you can see down here, and has a return of 10.02% in those 78.4 days. The annualized return of 56.02% should be taken with a grain of salt. All it means is if a stock's price increases 10.02%, every 78.4 days, you get an annual return of 56.02%. So just be aware that the annual returns of these two newer portfolios, the tech stock portfolio and the capital light strategy, could change a lot over time, but they will start to settle down as the holding period gets longer and longer, because we're not selling these stocks frequently. So the annual return or the average holding period will get longer and longer. And the purple box over here on the lower left, I've broken out the dividend payers versus the non-dividend payers in the tech stock portfolio. Turns out that so far the dividend paying stocks have been outperforming the non-dividend payers, as the dividend paying stocks have provided a total return of 35.76% per year versus 11.64% for the non-dividend payers. This slide is showing the portfolio value over time for our original portfolio our dividend growth stock portfolio, which invests almost exclusively in dividend growth stocks. As a class project in 2022, we started investing $12.50 each week into the portfolio. It's now worth over $3,300 after 184 weeks. Each week, we take that deposit and split it up to buy 10 different dividend-paying stocks, so we're buying fractional shares of stock. Each week, we re-rate the stock, so the list of top stocks fluctuates from week to week. And in August of 2023, we started a second portfolio, this time investing in high-yield dividend-paying stocks. Now, on this graph, the tan line on the chart is showing what the portfolio value would be if we'd instead put the money into a savings account. In our first year, 2022, stocks and bonds both did not do well. As you can see, our portfolio had overall losses where the blue line falls below the tan savings account line. But the power of compounding is working in our favor as the portfolio really started to take off in November of 2023. And as I mentioned before, I'll update our tech stock portfolio in next week's video, which we started in late April of 2024. And for those who have been asking, all three of the portfolios are now on our website, beatthestockmarket.com. We post the stocks we're buying in real time on Mondays when we make our weekly investments, and anytime we sell a stock, as well as information about portfolio holdings and trade confirmations. Now, if you're new to my channel, I'm an accounting professor that teaches accounting. And I often show my students how to use accounting concepts that I teach to pick stocks because it gets the attention of my students and keeps them engaged. To show them accounting concepts in action, starting in 2022, we started a class project in which each Monday I invest real, actual world money, $12.50 per week, which is roughly the equivalent of $50 a month, into 10 different dividend-paying stocks. And because those original students are no longer in my class, I decided to make this video series to let them know how our portfolio is doing. Also, viewers can use our progress as inspiration for their savings goal and get ideas of company names that they can do their own research on. Before we get into which dividend growth stocks we bought last week, let's talk about my favorite investing books, which I get a lot of questions about. My two favorite books were the basis for the 3 stock screens I publish monthly on our website, which you can see on this slide. My favorite investment book is called What Works on Wall Street by Jim O'Shaughnessy, whose investment firm managed over $6.4 billion of investments when he retired. The book is the basis of 2 of the 3 stock screens I publish on my website, beatthestockmarket.com. They are the Trending Value stock screen and Consumer Staples stock screen. I update the stock screens monthly. So what is a stock screen? It's a set of criteria used to narrow down a large list of stocks to a much smaller list of stocks in which you can invest in or do further analysis of them. The book examines various ways to tell if a stock is undervalued by examining simple metrics like the PE ratio, PE stands for price to earnings, dividend yield, etc., as well as combinations of these simple metrics. There are a lot of tables and graphs in the book, so if you're a numbers geek like me, you'll probably like it. It also talks about the history of the stock market and the psychology of investing, which is also fascinating. The other book I recommend, especially for younger investors, was written by the son of the author I just mentioned. It's called Millennial Money and is the basis for the Millennial Money stock screen that we publish monthly on our website. Of course, you can follow the book and just recreate the screen on your own. It's a much shorter book than What Works on Wall Street. I'll put the links to the 2 books in the description of the video. I'm also in the process of putting these stock screens, as well as their legacy stock portfolios, on a separate Substack for those interested in those strategies. For investors who are afraid to invest when the market is near an all-time high and think they would do better by trying to time the market, which is extremely difficult to do, and I don't know anyone who can do it consistently over the long run, you might want to reconsider your position. A report from JP Morgan shows how investing at all-time highs led to higher returns compared to investing on a random day for time periods of 1, 3, and 5 years in the future, likely due to the power of momentum. Now, a very popular exchange traded fund that only holds dividend stocks is called the Schwab U.S. Dividend Equity ETF, ticker symbol SCHD. Now, SCHD is a large holding in my personal account, so I've been tracking SCHD's performance closely with our 2 dividend-paying stock portfolios. As of today, the average investment in our dividend growth stock portfolio has an annualized return of 22.24%. If we'd instead invested the same exact amounts into SCHD in the same days, the portfolio's return would only be 7.03% per year. Our high yield portfolio is also outperforming SCHD. Obviously, there's no guarantee that our portfolio will keep outperforming SHD at such a high rate, but I've been gradually selling off my personal SHD holdings and reinvesting into our 2 dividend-paying classroom stock portfolios, as well as most of our other strategies that we talk about in our video series, like the tech stock, sector rotation, capital light, and wide moat. I also prefer our actively managed classroom stock portfolio strategy rather than SHD's purely algorithmic approach where no one is overseeing the stock selection. SHD has had at times value traps in their portfolio, and that's not a good thing. So this slide shows our best performing stocks for our original portfolio, the dividend-growth stock portfolio, based on when they were initially purchased. Stocks in yellow, like Evercore, Crane, F&G, and Repositrac, have been sold. Broadcom is in first place with a 392% return. Evercore, an investment bank, is in second place with a 252.9% total return. Kellogg made the biggest move this week to 10th place as its stock shot up 30% this week alone on news of a takeover. Kellogg is up 109% since we bought it in a little over a year and a half. Now, the 2 worst performers are Atcor and Vestas Corporation. Fortunately, I only made 1 investment in each of those stocks instead of the average of 7 investments or so, but both are down over 50%. These 2 stocks are categorized as under-the-radar dividend payers in our strategy column. Only 8% of investments so far have been invested in these under-the-radar dividend-paying companies, which are defined as companies that have recently started paying a dividend. These under-the-radar dividend payers tend to be riskier because they are usually smaller companies, but studies have shown they historically beat the market averages by a significant amount. Now, the other 92% of our investments made in this portfolio, in other words, the vast majority, are in these stocks considered dividend growth stocks, as you can see in the strategy column. Now, and what is a dividend growth stock? These are high quality stocks with a great track record of increasing their dividend payouts to investors over the years. Now, despite some of the huge gains in the under the radar dividend payers like Crane Holdings, 132% gain in 18 months, and F&G Annuities, 117% gain in 12 months. And now, WK Kellogg's doubling in basically 20 months. The stocks on average in this category called under-the-radar dividend payers have not done quite as well. So I foresee us cutting back or eliminating our investments in the under-the-radar dividend payers in the future. Here's the usual financial disclaimer. This presentation is for informational purposes only and is not a recommendation to buy or sell securities or engage in any investment activity. It's all well and fine to get investment ideas from others, but you always need to do your own research. So here's a notice I sent to subscribers last Monday on 2 dividend stocks we were selling. We sold Applied Materials for an approximate total return of 77%. We sold because the stock is approaching overvalued territory. We also sold Bristol Myers Squibb. Wall Street consensus earnings growth estimate for Bristol Myers for next year is a decline of 11%, making it look like the company might have trouble raising its dividend next year. Since we're interested in dividend payers that will be able to raise their dividends in the future, we sold the stock, but it has not done as well. We only got about a 2% return, total return, which of course includes dividends. Now let's talk about the dividend growth stocks we bought last week. I posted these rankings to our website, beatthestockmarket.com, last Monday. Then we purchased the top 10 stocks. Again, remember, there's a free Substack that also shows this stuff on Mondays. On this slide are my ratings for the top 20 dividend-paying stocks this past week, but we are only buying 10 per week. Remember, we use many criteria to filter stocks, and if a stock is hovering near the required level of a certain metric, the stock can make the list one week and then drop off the list based on a small movement in that metric. Examples of criteria used to filter out stocks include required margin of safety and consensus earnings growth estimates over the next 12 months, which changes frequently. For consensus earnings growth estimates, I will only purchase a stock for this strategy if its earnings are forecasted to grow at least 5% over the next 12 months. That's because we want to invest in stocks that can continue to increase their dividends. A stock might have a 5.2% estimate one week and make the list, but the next week its estimate could dip to 4.9%. Which means that the stock suddenly does not make the list at all. This is just one of many filtering criteria we use to narrow down stocks to get our list we use to narrow down our list of investable stocks. Now, just because a stock doesn't make the rankings one week does not necessarily mean we will sell it. Each week when we list the stocks that we're investing in, we'll also alert you about any stock we are selling from that portfolio. Now, a good example of this, of what happened this week, is MasterCard, I believe, was extremely high in the ratings last week, but it didn't make the ratings at all this week. But that's because its margin of safety wasn't quite good enough to make the list this week. So each week we buy 10 stocks, and since we're investing such a small amount each week, it means we're buying fractional shares in our Fidelity brokerage account. The table on this slide includes a company's sub-industry, how undervalued they are according to our research, the risk rating, quality grade, and dividend yield. Remember, all these stocks pay a dividend and have recently increased their dividends, and our methodology used here indicates they're likely to continue to raise dividends. Therefore, this is a dividend growth strategy. Remember, this dividend growth stock portfolio is in a brokerage account separate from my regular brokerage accounts to make tracking this portfolio easier. So in my other brokerage accounts, I'm also investing these dividend growth stocks as well as our high yield stocks and our other strategies. Last week, I purchased over $3,000 of these strategies as I reinvest dividends and gradually transfer out of my main dividend ETF, SCHD, and buy these individual stocks instead. On this slide, I want to show the components to our quality grade. Quality-wise, we only invest in stocks rated B- or better for this portfolio for 92% of our purchases. The other 8% or so far I've been invested in those smaller, usually smaller, under-the-radar dividend-paying companies that have recently started paying a dividend. Now, risk is the first quality component, which we mentioned in the previous slide. The next quality component is competitive advantage. Obviously, the more competitive advantage a company has, the better investment candidate they are. The next quality component attempts to evaluate companies' management. Our evaluation includes both management's use of capital and general decision making, but our research also dives into accounting data to look for red flags in the company's accounting practices, as well as the quality or reliability of the reported earnings, also called profits. And finally, the last quality component is financial health. Remember that the risk rating is comparing these stocks to other stocks, not to other investments like bonds or CDs. Now let's look at the dividend growth grades of the companies. Remember, historically, the best performing stocks are those that both pay a dividend and have grown their dividend recently. Ideally, you want a higher dividend, high recent dividend growth, and the best potential for future dividend growth, but that's not the way it works. Companies that are already paying out a higher dividend yield rarely have the greatest potential for the greatest growth in those dividends. Now let's talk about our quality rating. One of the components is moats, a measure of competitive advantages. One advantage of companies with the best moats is if they pay dividends, they are more likely to increase dividends even during an economic shock when compared to companies with no moat. Now on this slide, Morningstar shows there are three categories of moats. On top, we have the companies with wide moats, which is considered the best category. This slide shows that during the 3-year COVID period, when supply chains ground to a halt and some companies saw a collapse in sales, about 80% of wide moat companies were able to raise their dividends despite many companies being in financial trouble. Only 18% or so cut their dividends. Now for companies with no moat, which is at the bottom of the chart, only 57% or so were able to raise their dividends, while over 30% were forced to cut their dividends. For that reason, many of our strategies only invest in companies with either a wide or narrow moat. While our quality ranking for stocks includes moats, it goes much deeper than just one metric. But if you want a simple metric for quality, moats are a good place to start. Of course, this slide only covers a 3-year COVID period. During normal periods, dividend cuts are much more rare, and on average, companies increase their dividends 5.5% to 6% per year historically. And on this slide, we're looking at our stocks that have raised their dividends recently. The holy grail of investing in dividend-paying stocks is to have the portfolio generate enough dividends to cover your annual expenses, a level I've reached despite being on a teacher's salary. Historically, dividend-paying companies raise their dividends 5.5% to 6% per year, which I mentioned before, and that's above the historical rate of inflation. This means a stock portfolio can produce the ultimate passive income stream, that being one that increases each year above the rate of inflation. So our two newest dividend increases this year were by EPD and PNC. Enterprise Products Partners, EPD, increases distribution for the second time this year. Its new dividend is 3.8% higher than the dividend a year ago, which is remarkable when its current dividend yield is already 6.9%. This is the 27th consecutive year of increases for the partnership. And a 6.2% dividend increase was announced by PNC Financial Services Group. This is the 13th consecutive annual dividend increase by PNC. So the last 27 dividend increases for the portfolio have an average of 7.7%. Here's a look at the top 10 stocks that make up the largest portion of our dividend growth portfolio as of Friday after the market closed. Remember, our goal is to build a conservative and diversified portfolio by limiting the amount we invest into one single company. Aggressive investors might not want to limit the investment into any one stock, but I'm a conservative investor. Therefore, we temporarily stop investing in a company if the company makes up more than 4% of our portfolio. This leads to a less risky, more diversified portfolio. It's true that our portfolio's returns would likely be higher if we always invested in our top 10 stocks, regardless of the size of the stock's portfolio allocation, but that also creates a more complicated, more volatile portfolio. And many investors cannot psychologically stick with a volatile portfolio. Volatility often causes investors to panic and sell at the worst time possible. So our portfolio holdings currently are 79 dividend growth stocks and 23 under-the-radar dividend payers. And 92% of the holdings are in the dividend growth, and only 8% are in the under-the-radar dividend payers. The under-the-radar dividend payers I will usually only invest in once, whereas the dividend growth stocks have an average of about 7 investments in each one. Some way more than that, and obviously some less. So now 79 dividend growth stocks might seem like a large number of companies to keep track of, but the spreadsheet we've developed for tracking the companies makes it obvious when to sell a company once we download company financial and accounting information into the spreadsheet. Now, by comparison, SHD, the popular dividend ETF that we compare our performance to, currently has 103 holdings, which is very close to our 102 holdings. That's just a coincidence. I foresee maybe this 102 holdings decreasing a bit. I'm not sure. We'll see what happens in the future. This slide shows the cumulative growth of the dividends we've received in our dividend growth stock portfolio. Dividends for the latest month increased 69.04% over the previous month. This chart shows how quickly the dividends are growing in the portfolio and is a great example of the power of compound growth. Albert Einstein is widely rumored to have called compound growth the most powerful force in the universe. Now let's talk about our high-yield dividend-paying stock portfolio. I've had several older students who are close to retirement take my classes. They were more interested in stocks with higher dividend yields and asked to start a portfolio using a strategy featuring stocks with higher yields than the stocks in our dividend growth portfolio. So in August of 2023, we started investing $12.50 each week into stocks with higher dividend payouts. Now, the portfolio as a whole has an annual return of 24.83%, and I'm still surprised that it's higher than our dividend growth portfolio. Currently, the high-yield portfolio's dividend yield, if you waited until today to buy all the stocks, would be 3.89%. Now, compared to our dividend growth stock portfolio, the companies in this portfolio likely will not grow their dividends as fast. Therefore, this portfolio is more geared towards investors closer to retirement. Having said that, many stocks in our portfolio have increased their dividends, and we've been able to sell some stocks at a high amount and reinvest into better bargains, pushing the portfolio's yield based on the amount we've invested to 4.67%. Now, 2 strategies are being implemented in this portfolio, as you'll see on the next few slides. Strategy 1 emphasizes a high dividend yield over dividend growth. Strategy 2 also features stocks paying higher dividend yields, but places a bit more emphasis on recent dividend growth than Strategy 1 in an attempt to try to get the best of both worlds, both high yield and dividend growth. Strategy 2 has been the better performer so far. The average investment in Strategy 2 has provided a total return of 18.17% and has been held for an average of 242 days so far, which is an annualized return of 28.64% using Excel's rate function. Now let's talk about the high-yield dividend-paying stocks we bought last Monday. I posted these rankings to our website, beatthestockmarket.com, last Monday. Then we purchased these 8 stocks. And remember, there's going to be some duplication, such as Comcast is in both of them and Merck is in both of them. There's usually some duplication. Now, strategy 1, like we said, emphasizes a high dividend yield over dividend growth. That's perfect for investors in retirement or getting close. Strategy 2 still emphasizes high dividend yield, but places a bit more emphasis on recent dividend growth in an attempt to get the best of both worlds. Now, because there are 2 different strategies, we have 4 stocks in strategy 1 in red and 4 stocks in strategy 2 in green. So each week we take $12.50 and split it between the 8 stocks. So each stock gets a 1/8 weighting. Now, both strategies still only invest in high-quality stocks, meaning a quality rating of B- or better. The 4 high-yield stocks we bought last week while implementing Strategy 1 are Novo Nordisk, Comcast, Royal Bank of Canada, which is a recent new addition to the portfolio, Merck. And then for Strategy 2, we got Comcast, Merck, Pepsi, and UPS. Now here's a look at last Monday's ratings for competitive advantages, management, and financial health. And on this slide, we can see last Monday's grade for recent dividend growth and current yield, as well as recent dividend growth history. And the last column, you can see their grades for dividend growth potential, which will be much lower than the stocks in our dividend growth portfolio, which consist of stocks with usually lower yields, but a greater potential for excellent future growth in those dividend payouts. So that's it for this week. In the comments, let me know if you have any questions. Also, let me know what portfolios or investment strategies you'd like to see more of. And finally, here are the places you can reach me. YouTube, obviously, as well as our website, beatthestockmarket.com, Substack, LinkedIn, and Twitter. I'll talk to you next week with another portfolio update, most likely about our tech stock portfolio, our wide moat strategy, capital light strategy, and our newer sector rotation strategy. See ya.